Welcome back, traders. Today, we are taking a deep dive into the evolving market landscape as Trump-era trades start to misfire and the US dollar weakens. For months, investors bet on a stronger dollar and higher bond yields, expecting President Trump's aggressive trade policies, tariffs, and tax cuts to fuel inflation and keep interest rates elevated. But as we move through 2025, that narrative is starting to unravel, shaking up the Forex and bond markets. Let's break down what's happening, why investors are reassessing their positions, and what it could mean for the markets going forward. At the start of Trump's second term, investors were positioning themselves for a dollar rally, anticipating that the administration's trade war would increase inflation, drive Federal Reserve policy, and push Treasury yields higher. Initially, this played out as expected. From late September to the end of 2024, the US dollar surged 8% against the basket of major currencies, and 10-year Treasury yields climbed to 4.8%. In January 2025, their highest level since 2023. But fast forward to today, and we are seeing a shift in sentiment. The dollar is down 0.4%, while treasuries are rallying, pushing yields back down to 4.54%. Investors who piled into Trump trades are now pulling back, questioning whether the administration's economic policies will have the bullish impact they initially expected. A key factor behind this reassessment is Trump's approach to tariffs. While his administration has moved forward with new trade restrictions, they haven't been as extreme as many feared. Investors who had positioned for aggressive tariff hikes across the board are now unwinding their trades, realizing that the actual policies are more measured than the market initially anticipated. At the same time, concerns are rising that the US economy may be slowing down. What started as a bullish outlook, where tariffs would drive inflation and keep interest rates high, is now shifting toward fears of economic weakness. If trade conflicts escalate, they could hurt global trade, dampen economic growth, and create headwinds for the US economy. Bond markets are caught between two competing fears. On one hand, investors still worry that tariffs and inflationary pressures could keep prices high, limiting the Federal Reserve's ability to cut interest rates. On the other hand, there's a growing concern that a prolonged trade war could lead to an economic downturn, pushing investors towards safe haven assets like US Treasuries. This uncertainty is keeping bond yields volatile as market participants try to navigate the changing landscape. Trump's trade policies remain a major wildcard. Earlier this month, he walked back threats to impose immediate sweeping tariffs on Mexico and Canada, opting instead for a 30-day delay. However, his administration did proceed with a 10% tariff increase on China and hinted at potential new tariffs on Japan, raising concerns about trade relations with the US's key Indo-Pacific ally. Emerging markets, which were widely expected to be hit hard by Trump's trade war, have also surprised investors. After a difficult 2024, many emerging market currencies have rebounded sharply in 2025. The Chilean peso is up more than 3%, while the Colombian peso and Brazilian real have gained over 6% against the US dollar. Bank of America strategists have now turned bullish on emerging markets, arguing that the dollar's strength is overstretched and that many emerging economies have already priced in the worst-case trade scenarios. With central banks in countries like Mexico, the Czech Republic, and India cutting interest rates to stimulate growth, the appeal of emerging market assets is rising. So, what's next for the markets? For currency traders, the key question is whether the dollar will continue to weaken or if this is just a temporary pullback. If concerns about US economic slowdown intensify, we could see more downside pressure on the dollar, especially if the Federal Reserve signals a shift toward rate cuts. For bond traders, the market remains caught between inflation risks and recession fears. If growth concerns continue to build, Treasury yields could fall further, driving investors into safe haven assets. And for equity markets, the next moves will likely depend on how the global economy absorbs Trump's trade policies. If emerging markets continue to strengthen, it could signal that the worst of the trade war's impact has already been priced in, offering new opportunities for investors willing to take on risk. As always, traders should stay informed and monitor key economic data, Federal Reserve signals, and geopolitical developments. The market is moving fast, and understanding the changing landscape is essential for making informed trading decisions. What do you think? Is this the beginning of a sustained dollar decline, or will the Trump trade narrative make a comeback? Drop your thoughts in the comments below. If you found this analysis valuable, don't forget to like, subscribe, and turn on notifications so you never miss an update on market trends and trading insights. Thanks for watching and happy trading!